folks. In an ever-exceeding attempt to fast-track my financial independence and retire early journey, I continue to scale down on my high-flying growth stocks when we're talking about things like Tesla, like MyMed, and I think it's ever important to constantly update you guys on the dividend stocks that I love, how I feel about them, and how my opinion changes, because recently I bought some. I'm going to share with you some that I'm going to continue to look at moving into 2021, and something that's even really cool. A few weeks back, I shouted out a channel called Let's Talk Money with Joseph Hogue, and he actually commented on that video, and he says, "Great video, Kyle. Love the enthusiasm and the energy. I've got another video on the best dividend stocks for 2021 coming up in a couple of weeks that you might like as well." And he also commented on Granite Real Estate Investment Trust, which I'm going to talk a little bit about in this video. But after watching that video, which I'm going to leave the link to in the description below, he actually picked a REIT that I find really attractive that I think I'm going to add to my buy list. But we'll touch base on that in a second. So in the clarity of my transparency, do the channel a favor, smash that like button, and let's jump right into this. Welcome back, my passive income investors. I hope you guys are having a wonderful weekend as I try and show you kind of how my opinion changes around some of these dividend stocks and where my kind of attention continues to be moving forward. And I want to touch base on the Joseph Hogue video first, because he pulls up this REIT called Medical Properties Trust. And I've been trying to look more into medical stocks because going into next year, I'm likely going to start scaling down my MyMed position, and I'd still like to replace it with some medically based stocks, because we all know that even with Warren Buffett getting into things like Pfizer, it's just a very attractive place to start parking some capital. Now, this trust I actually never really heard of before until I watched Joseph's video, so he actually did a really good job kind of synopsisizing it. I'm going to play that clip for you very quick, and we'll be right back.
Our first dividend stock for 2021 is a favorite of mine, Medical Properties Trust, ticker MPW, for a 5.5% dividend and a long-term cash flow machine. MPW owns more than 390 hospitals, long-term care facilities, and other medical assets in 9 countries. At $17 billion in assets, this is the second largest owner of hospital beds in the United States. And this is a very well-diversified portfolio of assets, maybe a little heavy in that general acute care with 80% of assets, but very little in that senior care facilities that have hurt those medical REITs over the past year. It uses a sale-leaseback strategy for its acquisitions, which just means it buys medical properties from the healthcare companies and then leases the property back to them. But anything affecting the tenants is gonna hit the landlord as well. The upside here, though, is that as we do get back to some version of normal and those elective procedures get scheduled, hospitals could be flush with cash, and that uncertainty is going to come out of the shares in MPW. Medical Properties Trust announced its 8th consecutive year of higher dividends. The annual dividend of $580 million is just 80% of the funds from operations here, and we've already seen how this cash flow is just super stable. The balance sheet is also fairly clean here, with no debt maturities next year, and total debt is spread out, other than about $3 billion to refinance in 2024 and 2025.
But considering it is trading up 88% over the last 15 years, plus that 5.22% dividend yield that has slightly increased over time here, guys, you're getting a bit of market average return off this. But again, it is a very well diversified medical REIT. I really think it's one of these more premier ones. Now, I haven't deep dived down too much, so I'm going to do more due diligence on it, but I think it's a really attractive REIT, which means I want to talk a little bit about the one he commented on with Granite Real Estate Investment Trust, which I told you guys I've been highly focused on logistics and industrial based REITs because they've been an incredible growing part of this pandemic in the REIT sector. And the one that comes up the most for me has been Stag Industrial, guys. Now, I was kind of competing these two together because Granite being on the Canadian side of the border, I do get the tax benefits that come with that. But the problem is like 30% of their exposure, I think 36% is exposed to Magna, which even though Magna is an incredible company, from the diversification aspect, that kind of turns me off as an investor. So when I kind of compared it against REIT being a very similar sized US industrial, I kind of found this one to be a lot more attractive here, guys. Considering the 5-year growth rate on this, it's trading up 64%. You're getting a 4.74% dividend yield that has increased every single year. Mind you, not by much, but when you're already starting at a 4.7%, I mean, you just want stability here, right? Let alone the fact that you can get growth out of this. And even taking a look at the long-term chart here, guys, going all the way back to 2011, the stock is trading up 148%. So you are definitely meeting, if not beating, market average return here, guys. And the thing that I love most about this over Granite, like I said, is the unbelievable exposure to different industries and different sectors of the market. Considering Amazon is their largest tenant, making up 3% of their annualized income here, guys, with 61% of their tenants making more than $1 billion. I think you're getting a lot of security out of this. And the most impressive thing is their growth rate, considering they've been growing by more than $50 million year over year. And it just doesn't seem to slow down anytime soon. I really want to get that exposure to industrials. And I honestly think getting a medical REIT in here will give me the perfect diversification, with RioCan being in retail, GEO Group giving me some access to that prison REIT sector of the market. Then we'll get some industrials and some medical. And I think I'll be pretty good with my REITs overall here, guys, meaning let's talk about my stabilizers. I bring these ones up a lot lately because I truly think it's important to have stabilizers in your portfolio, because these are going to round out and balance the day-to-day fluctuations. And of course, I'm talking about Kimberly-Clark here, which is one of my favorite consumer staple stocks right now, paying a 3.15% dividend yield with a forward PE at a 16. It is definitely more favorable than a lot of the ones you can compare it next to, which we're going to look at a couple in a second here. But just taking a look, guys, this one isn't growing at the fastest pace, of course. If anything, they're more like reliable kind of retirement stocks that you could hold on to for the next 50 years and know you're going to at least get paid. Because just taking a look at their total revenue here, it hasn't actually increased that much, going from 2017 to from 18.2 billion to 2019, where they said 18.4. I mean, you're really only talking about like a $200 million increase here, nothing like drastically substantial. I had no exposure to this sector of the market literally until about this year, when I started adding stocks like Pepsi. So I've been taking my high flying growth stocks, scaling them down progressively to add some stability to my portfolio. And yes, I have been buying Kimberly-Clark by selling my Tesla position, at which again, many of you know I still hold Tesla. I'm still going to continue to scale it down because I still think the EV market is kind of in bubble territory here. But taking a look, I've added about 22 shares of Kimberly-Clark. I am down slightly at 3.2% on the position, but I don't understand why here it says the research team rating is a buy, but there's more bears than bulls on the stock right now. But I don't really care, guys. I love this company a lot. And like I said, comparing it to the broader sector of consumer staples, I definitely think it's trading at much more of a fair discount, which makes me want to bring up this next stock. And I want to shout out one of our passive income educator members, being Robert, as he's been sharing kind of some photos because he's been trying to help out the community a bit. And I think he's been working for some food drives and things like that. And he really talks about how there's a lot of Kimberly-Clark and a lot of Unilever product. Now, as I continue to build out a robust portfolio, that comes with the idea that you need to get some global diversification. And I like the idea of being able to buy consumer staple brands on the New York Stock Exchange that kind of have global exposure, considering Unilever is based out of Europe here, guys, which does give you kind of that foreign currency fluctuations, which does get reflected on those bottom line revenues. But I'm not really concerned. These are multi-billion-dollar brands generating tens of billions of dollars. You're getting a 3.9% yield starting here. And yes, I am going to get hindered by some of that withholding tax. Considering the yield is starting much higher, it's going to cushion the blow a bit, and you should still be able to sustain above a 3% yield, presuming you're buying it in a tax advantaged account like I'm going to be doing likely when I start scaling down my MindMed position. And these are the stocks that are just going to continue to take you into retirement, that are going to make you sleep easy at night. Now, I'm going to put that aside, guys, and talk about one more sector of the market that I still think there's not enough people talking about it. Joseph Hogue actually touched base on this, and again, you can check the video link in the description below. But I got to talk about banks again here, guys. I don't think there has been any more of a screaming buy in the market than banks, considering a lot of people thought they got destroyed in this pandemic. But a lot of the Canadian banks especially had continued to grow revenues in this pandemic. But if you looked at their bottom line earnings, you said they did crappy. Like, their earnings went in the toilet, but that came from what they call loan loss provisions here, guys. And the most incredible thing, especially up here in Canada, living here, that I can give you guys some insights, is before this pandemic even took place, the banks were getting kind of worried about the high flying real estate prices here. So they already started building up an excessive amount of loan loss provisions that really cushioned the blow leading into this pandemic. And honestly, when we get to the other side of this going into 2021, guys, and they're not showing any more, loan loss provisions they're setting aside, we're going to see that increase in revenue growth that they've experienced through this pandemic finally start hitting the bottom line, which is when I think we're going to see these things really take off. And on top of that, yeah, you could say we're in a low interest rate environment, which also hinders those revenues. But in the same time, guys, again, on the other side of this pandemic going into 2021, we're probably going to see an increase in interest rates, which again is only going to reflect a more robust earnings season for these companies when we're talking about things like TD, Canadian Imperial Bank, Bank of Nova Scotia, RY, Royal Bank, and of course Bank of Montreal, at which I have been adding pretty aggressively to all of these. I scaled down Apple to buy into CM and BNS, and I've been throwing my own working capital at BNS and TD as of late. These will be sectors of the market that I'll probably continue to add into because, again, these Canadian banks all yield somewhere between a 4 to 5 and 6% yields right now, and they're just screaming buys to me, and I'm just going to continue to add them. So I pass the question off to you guys. What stocks are you interested in? Can you rebuttal me? Do you think I shouldn't be buying some of these? And if not, let me know why. And along with, what dividend stocks interest you the most for your long-term retirement plans, guys? I try and do a nice balance of my growth videos with these dividend videos. So I hope you guys enjoy kind of the mix of both. But in light of all of this, stay cool, stay awesome, and I look forward to catching you tomorrow.